we're actually getting pretty close to the lows. So remember, PIMCO came up with the new normal concept a couple of years ago now, and part of that concept was a new neutral rate for Australia of around 3%. So given that we've already moved down all the way to 2%, most of that price action at the front of the yield curve is already behind us. So PIMCO is probably not that bearish actually anymore in relation to how low rates can go. And this more recent backup in interest rates is actually great news for investors, for advisors, especially for those in retirement or approaching retirement, that we can start to see some real returns being offered again within the bond market, which and the lows that we saw in interest rates back in January and February of this year, I don't think we're going to revisit those lows any time over the balance of the year. I think the very bearish investors out there, we think they're probably a little bit too bearish. So our advice is to all investors is stay invested. Don't be scared of markets. Don't move back to cash. You can still generate returns from equities. You can still generate returns from bonds. But the key message is that lower for longer remains with us. So to the extent that these low interest rates are justifying higher risk asset prices, we think that remains valid. While we do think the Fed moves off zero in this calendar year, it's going to be very, very measured, very, very gradual in nature. So stay invested. Don't lock yourself into cash rates that are generating negative real returns. There's still plenty of opportunity out there for investors, and our advice would be don't get too bearish. It's very easy to paint the really negative picture. The Australian economy is under pressure. The growth rate potential for us is lower than it was. The transition from mining to non-mining is very, very slow. I think we used the word glacial in some recent PIMCO commentaries, and that's still very much the reality. But we're near the lows. The RBA may have to move one more time. It's even that's not a given, and we think that 2% cash rate, well below our new neutral rate, will be stimulatory for the economy. And now that with this recent bond sell-off, yield curves are steep, and expected returns are much better than they were a few months ago. One of the most commonly used words so far in the past few months in the media is this bond rout. And so it's a very negative word to suggest we've been through a bond rout. But my view is that a small sell-off in yields is no rout. It's just a reassessment of where fair value should be in interest rate markets. And despite that so-called rout, bond returns this year are still healthy. So across all of the sort of various available sort of sources of bond return, they're all in the very, very strongly in the positive territory, and almost all of them in the positive real return territory. So I think that's a testament to what bonds do for a portfolio, in that they generate income and they allow for reinvestment if yields do go up. So by no means do we think that bond yields will be going up forever, but much more importantly, even if they go up a little bit further, that doesn't mean we end up with negative returns. It means that we end up with increasing returns over time and maybe some short-term sort of flatlining of return, but it still looks like a very healthy environment. The final thing I'd say is the diversifying portfolios is a structural issue. It's not a tactical issue. You don't market time portfolio diversification. Portfolio diversification should be something that we all live and breathe every day of the week. And having allocations across the portfolio to different asset classes that are not completely correlated with one another, will ensure that investor outcomes over the medium term are much healthier in terms of their risk-adjusted returns. It's a bit disconcerting, I guess, for investors, especially those approaching retirement, that their assumptions around income in retirement are all being adjusted as real rates come down so far. And unfortunately for the Australian investor base, it's a reality that used to be something that foreigners had to worry about, but now it's relevant for the Australian investor base as well. Unfortunately, we think that's just something that's with us for the long run. So you're going to be reading about 4 or 5% real returns for taking no risk in the history books. You're not going to read about that in the papers anymore. That's something for the past. We know our banking sector is no longer constrained by funding or by deposits. They're now constrained by capital. So their willingness to pay up for term deposits and other things is now a thing of the past. So it's an unfortunate reality that expected returns for investors will be lower. But that doesn't mean you have to take a lot more risk. All that means is you need to be a little bit more conservative in terms of your assumptions. And that's why I said at the start, investors should stay invested. There's no point earning that negative return in a real sense by sitting in cash. The first message would be use the same consistent set of assumptions across your full portfolio. Okay, so if, for instance, you're worried about interest rates going up quickly, then apply that to every asset class. Now, that's not our view, so we say stay invested. Second thing is, bonds aren't all about interest rate risk. Bonds have so many different attributes that they bring to the portfolio. Obviously, income generation being the most important one, especially for retirees, but also in terms of allowing you to take other risks in portfolios by providing that anchor, that capital stability, then allows you to take some other risks. You don't have to take outsized risks for your entire portfolio. You can be very selective, knowing that you've got this anchor in the portfolio. And then finally, there's lots of other ways to generate those returns. So credit spreads, we think, continue to be attractive. Investing in all different slivers of the bond market in order to find relative value and find returns that are going to generate expectations well above the inflation rate. So I think it actually looks like a very attractive investment opportunity now that we've had a bit of a backup in yields. And at the end of the day, steep yield curves are the best friend of a bond investor. And we've gone from having a very flat yield curve in Australia only a month ago to having a relatively steep one right now, with the cash rate at 2 and many attractive investments out there generating 4, 5, 6% returns. The benefit of those, the ability to roll down the yield curve, will ensure that investment outcomes in terms of absolute returns are much higher than the headline yield would suggest.